Welcome to this episode of Equity Mates Investing Podcast. Today we're doing a deep dive on super microcomputer. If you enjoy this, please subscribe.
All right, Ren, well, where do you want to start with Super Mario? No, Super Micro. Super Micro.
Well, they say first you buy Nvidia,
Yes.
then you buy Super Micro.
Okay.
But I'd hazard a guess that a lot of people don't know Super Micro from Super Mario.
Nice.
And I guess that's the point of this episode.
To be honest, I hadn't heard of it.
Okay.
Yeah.
Well, get excited. 'Cause
Yeah.
It's
Well, after seeing
ripping.
the notes in here, I'm pumped.
So here's how you should think about this company.
Okay.
You just spent $40,000 on an Nvidia H1 chip.
Mm-hmm.
What are you going to run it on?
Well, it sounds like I'm going to be running it on Super Micro.
Yeah, you're certainly not going to be.
Servers.
Yeah, you're certainly not going to be running it on your run-of-the-mill,
Dell PC.
Yeah. Supermicro produced some of the highest performance servers and computing systems. So if you're building an AI-optimized data center, you're probably putting a lot of money in the pocket of Nvidia and Supermicro.
So Supermicro is a picks and shovels investment in the AI space, really, is what we're saying.
Yes.
So Nvidia make the chips. These guys make the infrastructure that the chips go in and essentially power this. Well, it's not the computing power, but it's the servers that go.
It is the
behind
computing power.
The compute power.
Servers are essentially just computers.
Compute, yeah. Rows and rows and rows and rows and rows of them.
Yeah, racks on racks on racks.
And the racks, yes.
Yeah.
Racks, fans, you name it. These guys are building it.
Now, that's what they do,
Yes.
but that's not why investors care.
Okay.
Most super micro investors don't care if they make servers or sushi. Here's why.
I'm sure they would care if
Nah.
they pivoted to sushi.
I guarantee you they don't. Here's why investors are so excited about it.
Okay.
How's this for share price movement?
Yeah.
Up 234% year to date.
Okay.
Up 533% in the past 12 months.
Shit.
Up 4,700% in the past 5 years.
Wow. So this is a story of significant growth.
Yes.
5,000% in the past 5 years. 500% in the past 12 months.
And honestly, that's just at time of recording. By the time we release this, it's probably going to have doubled again.
And it might also be doing sushi. Who knows? But let's have a look at the company history. Founded in 1993 by Charles Liang, who had a background designing and manufacturing motherboards for computers. Initially a 5-person company designing servers, but then in 1996, the company opened a manufacturing subsidiary in Taiwan called Abelcom, run by Charles' brothers, Steve and Bill. In 1998, they opened another subsidiary in the Netherlands. And then in 2006, they pleaded guilty to a felony charge and paid a $150,000 fine due to a violation of a US embargo against the sale of computer systems to Iran. So a little bit of a blip there. And then 2007, they IPO'd at $8 a share. And Ren, you spoke about the growth over the last 5 years, but 2008, $8 a share. Sorry, 2007, $8 a share. At the time of recording, it's close to $1,000. So this hasn't just been the last 5; it's been a pretty good story since the company was founded. But it hasn't been without its trials and tribulations.
Yeah, if that story to IPO is a story of making higher and higher performance computers while getting in a little bit of trouble along the way, that has certainly been the story since then. There has been some big
Questionable.
big issues that have come up, all the while just making servers that power our internet addictions.
And epic returns.
So here's some of the controversies over the years. 2018, Bloomberg Businessweek published a report citing unnamed corporate and government sources, claiming that China's People's Liberation Army had forced Supermicro's Chinese subcontractor to add microchips with hardware backdoors to its servers. Bloomberg claimed that those compromised servers had then been sold to the US government, including the CIA and the Department of Defense, and at least 30 US commercial clients as well.
Wow. It's a pretty significant allegation.
Massive.
Yeah.
Yeah. The Chinese hacked the CIA.
Yeah.
Yeah. 5 days later, Bloomberg issued a second report alleging that Supermicro manufactured data center servers that were being used by a US telco had also been compromised, this time by a hardware implant on an Ethernet cord. Now, we should be very clear, Supermicro deny those allegations.
Yep.
And they are just allegations. And we should also be very clear that Bloomberg made those allegations, and we are just reporting on allegations that Bloomberg made.
Nice.
Supermicro have the balance sheet to sue us these days.
Anyone.
So Supermicro said they were confident that no malicious hardware chip had been implanted. But Bloomberg didn't back down. 3 years later, in February 2021, Bloomberg reported that the US intelligence services knew that Supermicro had been compromised since 2011,
Okay.
but they didn't do anything about it because they wanted to see kind of like what would happen.
What, and they just limited what was done on those servers so that there was no...
So they reportedly warned only a small number of potential targets. So I'm assuming that's like the CIA
Yeah.
and the Department of Defense. And any
Hey guys, don't use these servers for anything classified.
Yeah. Staying in 2021, there were further controversies. This wasn't so much of an allegation. This is just etch from Supermicro.
Yeah.
November 2021, a joint venture of Supermicro and Fiber Home Telecommunications Technologies, say that 5 times quickly, they won a contract to supply servers to the Xinjiang region of China for public safety purposes. Now, for people familiar with what's going on in Western China, that's where the repression of the Uyghur ethnic minority is really happening. There's like a mass surveillance state. It's really sad, and it's pretty etched that Supermicro are involved. And that wasn't all, because then a month later, in December 2021, the Washington Post, together with a couple of Russian dissidents, reported that Supermicro had supplied 30 servers to Moscow for internet censorship in Russia.
So some pretty questionable customers, I guess.
Well, we've covered off China, Russia, and Iran.
Well, I mean, they obviously have servers that are popular for good enough for government. So
Yeah, which makes you think maybe they don't need to sell them.
they don't need to sell them.
If I was Charles Liang, I would perhaps say we don't need to sell those 30 servers
I
to
see
Moscow.
what you mean. Yes.
Because Microsoft would also buy
Yes,
them off
I
us.
see what you mean. Yeah. It's not business critical.
Yes,
I understand. Despite the controversies, Supermicro has ripped off the back of the AI hype. They've just replaced Whirlpool in the S&P 500. Now, this is how it happened. They had a market cap of $4.5 billion at the end of 2022. They then absolutely went on a run, and by March 2024, so call it 15 months later, they had a market cap of $60 billion, pushing them into the top largest 500 companies in America.
Yeah, it's pretty amazing.
Far out.
So the company today, one of the largest producers of high performance and high efficiency servers.
Yeah.
As we've sort of said, like, just imagine a data center with racks of computers, of servers. That's essentially what they create. Since June 2023, they've reported that they've seen a massive increase in demand for their large language model optimized AI systems featuring Nvidia chips. And so this is why people, the saying that seems to be going around at the moment is first you buy Nvidia, then you buy Supermicro. It's because they're so connected at the hip in terms of demand from data centers for AI systems.
You buy Nvidia, you then buy Supermicro, you then buy data centers.
Then you buy a Lambo.
Nice. Now we're talking. Then you buy the data centers, which are also indexed to these guys.
Yes, but the thing is, the data centers may not have as much long-lasting pricing power as these guys.
True.
It would be like the argument. It's like data centers have always been kind of a commodity. Right now, they're so in demand, so prices are high because it's just there's so much compute needed. But
Oh,
yeah,
I see what you mean.
you're a commodity
I see
more
what you
than
mean,
these guys
yeah.
are a commodity.
Yeah.
Yeah.
Well, speaking of not being a commodity, Ren, let's get to the financials, and we'll start with revenue. And the revenue story is kind of broken into two. Well, between 2016 and 2021, revenue has grown from 2.2 billion to about 3.5 billion.
Not bad.
Not bad. But the last 2 years is where we really see this AI story play out. So in 2022, revenue grew 46% to $5.2 billion. And then 2023 grew 37% to $7.1 billion. It is profitable, and the story sort of plays out the same. Profit margins between 2016 and 2021 were about 3%, but with the lowest being as low as 1.4%. But in 2022, that margin grew to 5.5%, and then in 2023, Ren, it grew to 9%. Love to see it.
Growing revenue and expanding margins. That's a pretty good recipe.
Yeah. But that's not all, Ren. Let's go further and look at their quarterly numbers. So FY24 Q3, it's the most recent we have from their preso in April. Revenue of $3.8 billion. That's up 200% year on year. Keeping in mind their annual revenue in 2023 was 7.1. Then in Q4, their guidance is 5.1 to 5.5 billion. So that's 133 to 152% growth year on year. What a story.
And then their earnings per share for Q3 was $6.65, up 308%. So in this instance, revenue grew 200%, earnings per share grew 308%. So revenue growing quickly, profit growing faster than revenue is a story of expanding margins as well. Here's the crazy thing, Bryce, and this is why I guess investors are so excited. Keeping in mind that price to earnings ratio is trailing 12 months. It's backwards looking. It's looking at the last 12 months of profit and comparing that to the price today. The price to earnings for Supermicro, 49.
49.
Yeah.
That is, I feel like that's very reasonable.
It's
very reasonable.
Yeah, it's, I mean, like,
49.
to put it in context, like fast growing Australian businesses, Ordinate, 81.
Wow.
WiseTech, 145.
Whoa.
Like, they're not putting up the growth rates that Supermicro are putting up.
Well, if you annualize that quarterly revenue number, they're saying that they're on track for annualized, almost 20 billion in revenue, up from 7.
Yeah.
pretty incredible.
Crazy.
All right, so that brings us to the future, Ren. How do we think about the future here? Is it just that we extrapolate growth of AI and large language models and compute power, and these guys are just so tied to that and a central part of that story that that's the assumptions here?
Yeah, I mean, like, that's why everyone's piling in, it seems. I think right now, Nvidia and Supermicro are indexed to the growth of data centers. And it's incredible, the growth that we're seeing. You had some stat about Microsoft that they were like going to build 100 data centers in the next decade, and now they're building like 100 a year or something like that.
Yeah.
Like stupid growth. And that's just one company. Like, everyone is trying to build as much compute capacity as possible to power this AI revolution. And that's great. So for me, the questions become three. First of all, how long lasting is this AI revolution?
Yeah.
And like, I don't know how serious that risk is that like there isn't meaningful value created by AI. It seems like that question's kind of been answered. That it's like here to stay and it's created value.
Yeah.
But that is always a question.
Yeah.
That it's like, is it overhyped? Will there be the classic analogy? Is this going to be fiber optic of 2000? When like all of these companies raised so much money in the first tech bubble to lay fiber optic cable, because there was just a thesis that the world's going to need faster and faster compute and internet connection and all of that. It's here to stay. It's changing the world. We're going to build the infrastructure to power it. And all of these companies raised a whole lot of money, laid a whole bunch of fiber in the ground, and then went bankrupt. And the thesis wasn't wrong. the thesis that the world's going to need faster and faster internet and that this fiber is going to be valuable was right. It just took 20 years longer to play out than people expected. And so maybe there's a question there. Like maybe we're going to build a shitload of data centers in the next few years and then a whole bunch of companies are going to get over their skis. The value isn't going to be there as soon as people thought. Those companies go bankrupt, like potentially. And then Supermicro, so much of their revenue will be tied to those data centers and then their revenue will fall. Like that isn't a crazy way to think about this.
But isn't it driven the other side though? It's not driven by the data. Like the data centers, the demand is driven by up the line, right?
By
it's the end users.
open,
like they're the ones that need. They're the ones that will drive whether it goes out of business or not.
But people are investing in data centers today based on expected future demand.
Yeah.
So right now, there's enough compute and enough data centers to power the amount of AI we are all using today.
Yeah.
But they're building data centers for the future. But if our adoption of AI and the use case of AI don't roll out as expected, then there's going to be a lot of data centers that all of a sudden can't earn a good enough return because there's an oversupply. So then prices come down and then people start to fold and then Supermicro loses their key customer base. Same with Nvidia. And I'm not saying that's realistic. I'm saying that is a story as old as time with technological developments. And so that's one question and one risk that you have to think about if you're investing. Like the idea that this just goes up and to the right with no interruption very rarely plays out like that. There will always be challenges. Question one. Question two, competition. Right now, Nvidia and Supermicro seem to just have this privileged position where they can charge what they want and anyone's going to buy it. How long will that continue? Because everyone's going to want to try and get into this space. No one's going to want to pay the prices these guys can choose to charge. So that's going to be a question. Who catches them? Can anyone catch them? How big a lead do they have? I don't have the knowledge to answer that. And then third question is just price. Like right now it's trading at a 50 PE. That's probably not crazy given how quickly it's growing. But you're listening to this. What price is it when you go to buy it? That's the final question.
Ren, we'll leave it there. Two great questions that we will make sure we pick up on the other side of this break when we bring in John to unpack the investment case of Supermicro. Welcome back to Equity Mates. We are doing a deep dive on Supermicro, and it is that point in the episode where we're bringing in a guest to help us with the investment case. So it is our pleasure to welcome PhD Chief Equity Strategist and Economist at Zacks Investment Research, John Blank. John, welcome to Equity Mates.
Alec and Bryce, thanks for having me.
So, John, before the break, we covered off the history of Supermicro and had a look at sort of the top line revenue and sort of discussed a bit of the future, which we'll get to in a moment. But we're really interested to start with how you analyze a company like Supermicro. So we'll start there. What is it that you're looking at when you're analyzing the investment case for Supermicro?
Okay, so Supermicro at this point in time is considered a large cap stock because it's got a 50 billion market cap. So first thing to notice here, when a stock gets over 5 billion in market cap, this is 50 billion. It gets a lot of treatment from Wall Street because it can be put into institutional investor portfolios. So what we first have in the investment case here is this is a bona fide large cap stock. And if you look back a couple months ago, it got put in the S&P 500, which is another level of maturity for a stock because then it trades in a major index, which will then be traded into all the ETFs that follow that index. And you're going to get a lot of liquidity with this stock. So this is a type of stock that then gets the analyst coverage from the Wall Street sell side. Because if you also remember with Supermicro over the last 2 or 3 months, we've had equity offerings because the sell side wants to do business with this company. So they will put coverage on it. I've got a setup here that's telling me there's 5 analysts on this stock. I think it's probably low. That's 5 analysts in our system. But what they do for us at Zacks is they provide the earnings estimates. And what this means is we track effectively this year's annual earnings and next year's annual earnings. And that is kind of the base structure, the fundamentals, like they like to say, for the company. Now, obviously, we can talk about revenue and valuation and all the other stuff. But at the end of the day, from this company's perspective, The change in the annual estimate in the forward 12-month period is the driving force for the change in the stock price. Now, so Alec and Bryce, what this means is a little different than what people think it means. It means when these analysts that are covering this stock get more bullish and grade up the vision of what the earnings are, that's much of the information that's not priced into a stock over the short term. So for an example, in Supermicro Computer, I've got $22 a share 60 days ago. I've got almost $23.50 going into earnings for Nvidia a couple days from now. So that's an 8% rise this year. And I've got $28.60 next year going to $34. That's a 19% rise. So what this is telling me is we have a number one rank on this stock for the short term because 8% or 18%, depending on how far ahead you want to look, is not being priced into the stock. So the stock's at 900. You can get to 1,000 or 1,100 on a stock like this just on the market pricing in these new estimates. So that is kind of the core, sophisticated way that we're thinking about this stock.
Lay it out for us for people who are investing in Supermicro Computer. What's the bull case these days?
Yeah. Okay. So here's the bull case. Number one, the industry it's in is a strong industry. Computer storage devices, they're basically in the rack server business for these data centers, putting the Nvidia chips in place, which you probably already covered. But that entire industry is in our top 9%. It's number 23 out of 249. So we track 250 industries, and when you get into the top half of industries, you get outperformance on a stock, no matter what the stock itself and the company itself does. So here you have a dominant player in a hot space, and that is really the sweet spot. So the one bull case is the actual industry is strong. This is a strong stock and a strong industry. That is probably the best bull case. The next one, like we said, is the estimates. The third is, we've got a story momentum-wise that has been going really well for, basically a year. I mean, I look at a share price start, and generally speaking, it started last June when this was move out of COVID towards, aggressive data centers by these big tech companies in the United States started to put these rack servers in place. But just from the perspective of what are people buying, when stocks move up on price like this, these big institutions are buying this stock. Until we get a period called distribution where people are selling this stock, you got to kind of look at the chart and say, okay, hey, you know what? People are still buying the stock. We're close to the top on the stock with the estimates. 8% and 18% is probably the upside here, not what you're hearing out there in the marketplace.
Yeah, I guess that's always a question that I have is when does, a stock like this that has so much momentum, you want to ride that momentum, but you want to get out at the right time. So what are those sell signals that you're looking for?
Oh, guys, look, long-term investors should stay away from the stock. I'll give you an example, Mark. Right? Seriously, this is the dead wrong stock at the dead wrong time to buy. Here's the valuation score for our system, F. Here's the growth score for the system, F. Here's the momentum score for our system, F. Right? You don't get worse long-term quantitative metrics from a stock than that. FFF. So what this stock has become is a number one ranked short-term 1 to 3 month pick for 10 to 15% in gains and getting out. It is the dead wrong place to be as a long-term investor. If you're looking for anywhere beyond 1 to 3 months, this is not your stock.
So, John, 1 to 3 months is the time horizon you have on this. Can you speak a little bit more to valuation or perhaps the bear case and some of those metrics? We are long-term investors here, and so when we look at this company, you mentioned the industry that it's in, and we were talking before the break, where are we in the cycle and the adoption? Is this something that Ren gave the example of the fiber optics of the 2000s where
there was a lot of capital deployed and then a lot of companies fell over.
Yeah.
But you look at some of the rosy projections for data centers. I think Microsoft were going to build 100 data centers over the next decade. Now they're trying to build 100 a year or something stupid like that. And so you can see some pretty wild projections for companies like Nvidia and Supermicro. But you just mentioned there that it's not a great long-term play. So, yeah, tell us how you think about, I guess, the downside in a stock like this.
Yeah, one thing I've learned about a growth stock like this and this is really completely consistent with only growth stocks, the forward price earnings ratio on a growth stock is its annual growth rate. As a rough metric. What I mean by that is I have a 38 forward PE on Supermicro. So the market is basically pricing in annual growth of 38% a year on a stock like this. So what you have to sit down and decide here, you're not going to beat the market, but just try to understand this market. Your understanding is the market's pricing Supermicro that it is going to deliver basically 40% a year annual growth in their rack servers for at least the next couple of years. Beyond that, the market will reprice it. But then, so you got to sit back and say, do I think that sounds outlandish? And I think you guys and I would agree that doesn't, right?
I think it sounds pretty reasonable.
It sounds like too reasonable.
Yeah,
we were
yeah.
speaking about some of the growth stocks in Australia, and they're 100 PE.
Yeah, that's it. It's fascinating to step back. One of the things that was interesting, there's also a thing called the price earnings growth ratio, which is, it's a concept called GARP, G-A-R-P, growth at a reasonable price, which is an institutional investing concept for the long-term investor, where you want to get under, at least a 2 in the PE ratio, and generally under 1 is really good. So what is the PEG ratio for Supermicro? 0.72.
There you go.
Yeah.
Wow.
Okay.
So again, here's the rub though. I told you to use the forward PE ratio as the growth rate, and it was about 38. I'm looking at expected earnings growth in our system at 52%, right? So that PEG ratio is incorporating that 52% number, right? So if I actually look at the valuation at 38 and realize, no, it's probably 20 to 30% lower, then the PEG ratio is basically 1 to 1.5, not 0.7. And there's just a ton of flaw. Again, 50% a year versus 40% a year on a company like this, 50% a year is incredibly big. You're basically doubling your company in 2 years.
Yeah.
40% saying you do it in 3. I can kind of get 3. I don't know about 2. And the problem I have with this business, when I put up a rack server data center with Nvidia chips, what do I do when I get that done? Do I go out and run it for a while? Yes. Do I just decide to build more? If anything, I'm going to hold on for a long time and holding out until I get the capacity utilization of that rack server up with the existing chips. And then the problem down the line is, there can be competition on the chips, not the rack servers, because this is a rack server business, not a chip business, but the chips are all the whole thing. So then what happens when the next round of chips come? You can basically swap out the chips and not the rack servers. And so then the problem here is the existing server infrastructure may be, all that these folks need, and they just start swapping chips out 2-3 years from now in the next cycle. I mean, capitalism is about creative destruction, and this business is eating itself alive. I mean, all that's happening here is they're putting in Nvidia chips for other types of chips, or now, Qualcomm's working at Microsoft to put in Nvidia style chips, but everybody's basically upgrading chips that are out there to do these new capabilities. And that's basically the problem with a stock like this is they are not a chip company. They are not a chip company. And the downstream creation and destruction of chips can leave them, kind of like, basically a very commodified, environment where it's not that big a deal to put together racks and servers if you know who to talk to.
Well, that's probably a good point to move to the final question, John, which is around the company in the future. And I know you're looking at much shorter term, but if you were to look at the company in 10 years' time, what would you expect it to look like, or what are some of the scenarios that you think might play out?
I think they'll get bought or sold. It's very tough to not see somebody want to acquire them. And use them in some kind of portfolio environment. For example, I could see Intel or even Nvidia acquiring them, going into a vertical integration type framework.
Oh, that's interesting. Yeah.
Yeah, because like you're saying here, the forward P of 38, 50 billion market cap. A 50 billion M&A deal is nothing for Wall Street. Nothing. Yeah. So the M&A guys are going to be circling around a stock like this for the next couple of years, and then the question is who benefits, who can buy them. For example, ASML in the Netherlands, which makes chip wafer fabrication type devices. Maybe they get in with a chip company, and then maybe they buy Supermicro and vertically integrate. Right.
Well,
Okay.
it seems like there's been a little bit of an uptick in M&A, so it'll be an interesting one to watch. But John, look, we really appreciate it. This is a fascinating company that's kind of, at least for us, has really come out of the blue and captured everyone's attention. So it'll certainly be one we're watching, and we'll be interested to see how it plays out.
Absolutely, guys. I mean, the other stock I would tell you to watch is ticker is Vertiv, VERTIV. This is a stock that's also competing with Supermicro Vertiv.
Nice. I love that. I've never heard of this company before,
Okay.
and I love hearing about new ones. So that's great. We'll check it out. I'm just getting it
up 500% in the last year.
No way.
Similar.
There you go.
Similar
You're almost
vibes.
like you're talking to
Nice.
Chief Equity Strategist of Zacks or something.
Yeah. There you go. Vertiv Holdings. So they do similar. They build server racks
That's
like
it.
Supermicro.
They basically are in the
Cool
cloud
infrastructure.
server farm business. I mean, really what's happening here, guys, is on-device, service like your iPad, this computer, everything is going to a server environment where you basically acquire a faster chip and more power inside of a big server farm. So that's basically what's happening. And the basic difference, of course, is you and I cannot afford that, right? So it becomes institutional, and these
Yes.
big groups that came out of COVID, these big 7 companies with tens of billions of dollars are just putting a ton of money to work building out that infrastructure. That's Amazon Web Services, that's Azure at Microsoft, those types of groups.
Yeah.
Wow. Well, that's certainly a cliffhanger that you've left us on, John. We'll have to look into Vertiv in a little bit more detail. So thank you so much for taking the time with us today. We do really appreciate
You
it.
bet, guys.
Equity Mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.